Coming up today, the S&P closes at another record on news of the third official trade deal. Could we get a rate cut later this month? The latest numbers from Tesla, UK yields spike higher, and are we starting to see cracks in the US jobs market? You don't want to miss this one, guys. Let's go. Well, once again, a bullish day looking at the indices, but very mixed looking underneath the surface. With plenty of checkered breadth out there, utilities coming off today, big healthcare stocks, along with telecom getting sold down. Whilst we've got a bit of a bounce back in mega cap tech coming off there yesterday, and we've got a few things going on out there today, looking across the macro picture, one of which that likely helped stocks today is we got news of the third official trade deal by the United States, this time with Vietnam, a very important low-cost manufacturer, actually the sixth largest exporter to the States, and who many in the States want to somewhat replace China, or at least add more balance. And so it looks like the final deal will be the States imposing a 20% tariff on Vietnamese imports, with Vietnam also agreeing that goods would be hit with a 40% tariff rate if they originated in another country and were transferred to Vietnam for final shipment to the States, also known as transshipping, which are used to circumvent trade barriers. And just like I've been saying all year, the end result is a better deal for the States, with Vietnam not going to impose any tariffs on US goods. And so at the end of the day, this is of net benefit to America and American companies. That's the only way they're going to sign deals. Since we're coming from a place where America's been at a disadvantage, but now their immense leverage is being used to get better deals. And that likely helped a bit of a recovery in the mega cap tech. Apple once again doing well here today, pushing up against this resistance zone. Could be on the cusp of catching up to the rest of the market. Nvidia trading up, hovering around highs, and it was actually Tesla, the best performing mega cap tech stock today, even though we just got the latest delivery numbers and they fell year over year again. I'll get into that a bit later on. But it was once again the Russell 2000 small caps outperforming the S&P 500 here again today, up 1.39% versus a SPY 0.45%. And just looking at the spread chart between small caps and large caps, we could be on the cusp of completing this massive bullish divergence. Looking at my DSI indicator here. But we still haven't quite broken out of this multi-month base yet. But I believe there's a good chance we could, as small caps could be primed to make a comeback this summer. Lagging behind for some time now, and on the back of the big beautiful bill, big government spending likely to benefit small domestic companies that the Russell 2000 is full of. And even though we've got one reversal signal here on the Russell 2000, showing we may be in for a little bit of a pause here in the short term, it still only closed above its 200-day moving average yesterday. And you compare that to the S&P 500, which is quite a bit above its 200-day moving average here, relatively speaking, and it too also on a reversal signal. And this is one of my most accurate custom indicators I've developed on the TradingView platform. And just to show you, the last 10 times or so, we've got reversal signals here on the SPY. Can often signal we're in for a little pullback at least on the 11th of June, giving us a little bit of a pullback there in mid-June, again in late May, and just going back also in December. Reversal signals, pullback. October, they fired off a little bit of a pullback. Not too much of a pullback there in September, but a bit of a consolidation. And in the prior handful of times before that, this indicator also gave us a heads up. The market may be vulnerable to a pullback in August, July, June, and also May last year. So it does have a pretty high win rate and accuracy for showing when the market may be a little exhausted. And stick with me today because I'll show you what could be a catalyst for a pullback here. We actually got a little bit of alarming data, which I think is going to be adding pressure to the Fed as well. I'll also share with you some bets I made in the prediction markets today that I shared with my members. And we'll also touch on later on what's going on with UK government bond yields today, causing ripples through global credit markets. But first, just some data and headlines to give you the bird's eye view. And just as a reminder, guys, if you enjoy this type of content, then go ahead and smash that like and subscribe button. And I'll keep you updated every day after close. And once again, in today's trading session, it was small cap value forming the best. And this may not just be a little 1 or 2 day blip. This is often what we see at turning points in the market. You'll get that big kind of uncoiling, big candle, big volume, and that can often signal a shift in the market's positioning and possibly the end of a short-term trend. And that's showing up quite a few stats. Looking at the spread here between the equal weight and cap weighted S&P 500, spiking up and hitting highs, showing market breadth has been dramatically improving this week, something that's been actually lagging for a few months here. And that's the percent of stocks above their long-term 200-day moving average, which has dramatically climbed over this past week, going from 46% now to almost 59%, and this breadth measure as well, closing above its 200-day moving average. And that's a good sign because it basically shows more and more stocks are going up, not just the big mega cap tech stocks, which skew the indices. And so that's patterns we've seen coming out of prior market sell-offs and dips. You'll see it there in mid-2020 and also mid-2009. The market pushing up with more stocks participating, it's actually a good sign for the overall structure of the bull market. But like I just showed you on the chart of the SPY and my reversal signals firing off, we could be a little stretched here in the short term, even though we've got good medium-term signals firing off. And that's because we've had the quickest recovery from a 20% drawdown in history, tracking pretty closely to the 1998 trajectory of the market's recovery. And we can see in prior instances where the markets recovered really quickly, it was around this point of time, it kind of consolidated for a few months. And looking at the presidential election cycle, that's suggesting similar action soon as well, even though July can often be a good month in the market for the S&P 500 as a whole. Digging a bit deeper, it's not for high beta growth, as that often underperformed the defensive low volatility stuff, and value, which has been outperforming this week. But then the presidential election cycle suggests we can get quite a soft Q3 that can often come on any year, and then just a little bit better than flat into Q4. And it could actually be 2026 that follows that seasonality, and we get quite a bit of volatility and consolidation throughout the year before ripping into pre-election year, as markets typically like that, as politicians are typically trying to entice the public with many handouts and juice things up going into the election. And that actually played out in 2023 as well. So we've had this great recovery for a couple of months. We could be closer to a period of consolidation than not. Doesn't mean we're done hitting new highs for the year. We could very well come back for a good Q4. And what you'll notice looking back in history is that when the market is pushing up and hitting new highs, it often makes dozens of them, as you can see in this bar chart. Whenever the S&P's hitting new highs, more often than not, we get at least a dozen or two. So far, we've only made 6 new highs this year. And one can't ignore the immense momentum and trading volumes we've got in some of these hot stocks, with founder-led stocks attracting a lot of attention, as they're quite often the best long-term performing stocks. When the person who created the company is driving it and a large shareholder, unlike typical corporate management who run a bit of a evolving door style management, they get in there and try to juice things up for the short term, hit all their KPIs and bonuses before moving on a couple of years later. Founder-led stocks typically take a long-term view and vision. They're invested alongside other shareholders, and that can help to drive really big returns long-term. But as we can see in this chart here, there's some of the best performing stocks year to date. Robinhood up 159%, Hims and Hers Health 91%, Nebius 78%, Palantir, Carvana, Spotify, CrowdStrike, Rocket Lab. These are all retail favorite stocks, and they didn't just become retail favorites last week either. Some of these stocks have been well talked about and supported by retail investors for years now, and they're some of the best performing stocks out there. And this is a big driving force of this current bull market. Huge participation with record amount of people owning stocks now because it's so easy and cheap to do so. So the ammo is certainly there for us to go higher. And like many of you know, my theory is for this secular bull market to finally come to an end, I think we have to reach an epic blow off top, maybe the likes we've never seen before in history. Because even though we've got a huge amount of momentum and participation, a lot of bullish retail investors out there, we still don't have everybody on board. Still plenty of surveys showing more bears than bull. And again, markets typically top when everybody is bullish. Can't find a bear anywhere, but there is still plenty of bears out there, many of whom will likely FOMO into the markets the further and further that they run. And that whole narrative that built up in Q1 and probably reached a peak in Q2, that American exceptionalism had reached its peak or was dying, I think is already fading away. And I agree with this article as we approach the 4th of July, Independence Day. Markets shutting early tomorrow, by the way, 1 p.m. and shut all day Friday for the national holiday. But back to this article, I agree that America is the home of innovation. Famous saying in finance, America innovates, China replicates, and Europe regulates. But not only innovation, Americans work a lot harder on average than other Western developed countries. With many Americans lucky to get a day off for their birthday, quite often you'll email someone in Europe, you'll get their out of office auto reply, they've gone on vacation for 6 weeks. In addition to innovation and productivity, big money. US is the home of capital. Again, less regulation than Europe. It's a lot easier to raise, distribute, and find capital. And of course, American companies are a lot more profitable on pretty much every measure, allowing them to reinvest greater amounts into research and development, helping to hold on to their lead in innovation and creating new technology. And without a doubt, the States is the clear leader in AI, just like Philippe Lafont, founder of Coatue Management, $55 billion hedge fund, argues for as well, even calling it an AI supercycle, which he thinks we're still in the early stages and that we're going to see constant disruption, not without volatility. And that one thing for sure we've got going on is a CapEx supercycle, companies spending oceans of money to build their compute power and AI infrastructure. But there's many ways to play it, not just AI companies, but of course the raw materials that go into a lot of AI products. Silver, not just used as jewelry and a store of wealth, but also it's going to play a key role in the electrification of the world. with demand set to rise significantly above supply, whilst it's already in a structural deficit, with demand for last year and this year exceeding supply by over 100 million ounces. And so this is a key commodity and a lot of products of the future: electric vehicles, solar panels, batteries, and many other clean energy applications. And there's a look at silver futures on the daily chart. We'll be coiling up here on a bit of a bull flag and just going out to a 3-monthly chart to give you the long-term view on this. Also looking pretty solid. No doubt we're already in a bull market, but when we're pressing up here, just like we've seen in the past, it can often go into that banana zone and just go into a melt up. And staying on that 3-month chart, just looking at silver versus gold, looks to potentially be creating a massive double bottom, as it's still got a lot of catching up to do to gold, which has been outperforming for quite a few years now. And what's also started to perk up of late is silver miners versus the underlying commodity, as miners are like a high beta play on the commodity. When it's not doing so well, the miners do worse. When it does well, the miners do better. And there's a look at the Global X Silver Miners ETF, looking pretty good here on the chart as well. And in fact, it's pushing up right against 15-year resistance right at this point of time, which could also be on the cusp of breaking out. And this ETF gives you exposure to 41 global silver mining companies. It's a lot safer way to play silver than just one silver miner, as they can be quite risky and volatile on their own. And just moving on, and before I get into some other interesting items we've got out there today, Tesla deliveries, Oscar Health stock getting smashed down. I'll give you my thoughts on that, along with what's going on with British bond yields. First, let's just talk about a key item from some data we got today, which I think investors should be paying attention to here, especially as we're on the cusp of the jobs report tomorrow, which will give us a better look. But looking at the ADP jobs report, monthly change in private sector employment, we just got a contraction for the first time in 2 years. You can see this has dramatically fallen off the last 6 months, which is one of many signs we're seeing some softness or even potentially cracks in the US jobs market. We can also see that in initial jobless claims starting to trend up the last few months as well. And like this article on the Journal said today, the jobs market is starting to fall apart. We're not quite there yet with the 4-week average of jobless claims above 250,000, and same with other things like the SARM rule, unemployment rate, but we are getting close. If all these things were to tick up a little bit more, could be tipping the scales of the economy and the jobs market. And so tomorrow could be a key report, even though it's a half day of trading with a close at 1 p.m. going into Independence Day, which is normally a very low volume, low volatility day. A lot of trading desks close for the long weekend. We could get some action if it comes in a bit worse than expected, even though the market has been super muted to just about any headline of late. Many of us will be paying attention to what print we do get tomorrow, none the least being this guy here, Jay Powell, who's in the spotlight for not wanting to cut rate, even admitting he would have if it weren't for tariffs. But I agree with this article that the case for a Fed interest rate cut in July is getting stronger, especially if the jobs report tomorrow comes in a bit worse than expected. Economists thinking 113,000 new jobs were created in June. Goldman Sachs thinks it's going to be 85,000. Unemployment rate expected to be 4.3%. If we were to get 4.4, 4.5, and jobs come in less than 90,000, I think Jay Powell might feel like he has good justification to go ahead cut, especially since we're not seeing any spikes in inflation now that we're 3 months into tariffs. And interest rate markets are strongly suggesting that if he doesn't cut later this month, that he almost certainly will in September, because there is quite a bit of time between the July and September meetings. Currently, the market only thinks 7.6% chance he'll keep rates on hold in September. And what we've been seeing of late is building odds that we could get a cut later this month, which I think is a real possibility. Again, if the jobs report comes in weak tomorrow. As Jay Powell is largely data dependent, even though he's been a bit of a speculator of late, I think he just needs to see a little bit more softness in the jobs market to pull the trigger, because that is something he definitely doesn't want to get behind the ball on again. And that's why I extended my bets for a 25 basis point rate cut both this month and September, as I shared with my options trading members today, as the odds I've been getting on Polymarket are still quite a bit below Fed fund futures. I've been scaling into this. At this stage, I still think he probably will keep rates on hold this month unless we get a soft jobs report tomorrow, but it's also a bit of a hedge in case he cuts this month but not September. And I was able to average in at what I thought were good odds at 18%. And just looking at my September bet, that's when I think he's most likely to cut at this stage. Of course, things change a lot, especially in a couple of months in financial markets. So I could scale out of this bet, I could add to it. But at this stage, I'm happy with my average 50% odds that we'll see a rate cut in September. Because in addition to Fed fund futures, the 2-year yield is already suggesting the Fed is 2 rate cuts behind. sitting here at 379. And so regardless, I think Jay should cut rates, but are we possibly at the start of a new paradigm in the economy? We've already seen a rise in IT unemployment. We just heard again today, Microsoft, one of the largest tech employers in the world, they're going to lay off about 9,000 workers in their latest round, coming on top of roughly 6,000 roles the company eliminated in May. And a big part of this is AI, not only increasing the productivity of us all, but also the companies, even more so. They can do more with less staff, and that's helping to squeeze earnings per share higher. And so could we be entering a paradigm where unemployment goes up thanks to AI and robotics, but the economy doesn't contract, corporate profits don't contract, as this trend already appears to be underway? And we can see that in this bar chart of Amazon's employees versus robots, with Amazon actually having less employees than 4 years ago, whilst their number of robots has doubled. And again, that's driving amazing productivity gains for Amazon, because we can see their number of employees per facility is dropping dramatically, whilst the number of packages handled by Amazon per employee has increased even more dramatically. And just like we heard yesterday, Amazon just installed its 1 millionth robot, with robots at Amazon now overtaking the amount of hours worked by employees. So as what's happening at Amazon, which is a leading company in operational and back-end efficiency, a preview of what's going to happen to the economy at large. Because traditionally in business and economies, if a company's shrinking in employees, typically so's its sales. But as we see here in Amazon, it's actually the opposite. And so obviously this is a trend that could play out over many years, but it very well could rewrite the rules of the business cycle and the labor market's impact on the economy and corporate earnings. Moving on to another key company that is needing less and less employees to do more and more, and is also big on warehouse automation and robotics, Tesla. We just got their latest delivery numbers. Not so great, down 13.5% year over year. Didn't come in as bad as the worst estimates, but still a contraction nonetheless. But you'll be hard pressed to find any company in history, Amazon, Google, Tesla, where they didn't have a pullback in their numbers at some point. It's never just constant linear growth. With Tesla delivering 384,000 electric vehicles for the quarter, showing that they still have to prove to the market they can get back to growth for their core product. But again, just like we saw after last earnings that came in quite a bit worse than expected, the market just shook it off like it was nothing, as it appears to be still excited about robotaxi and humanoids, likely helping to keep it bid with its lofty valuation, given we're not seeing growth right here in electric vehicles. And I think it should be finally put to rest, the whole bear case argument, Tesla's only an electric vehicle company. They've actually got many products already and just around the corner, with their battery and storage business growing leaps and bounds, 100% year over year, doing tens of billions of dollars. And other things like full self-driving, which just like their charging network is likely to be licensed out amongst the industry. Let's not forget solar, trucks, robo-taxis, which has just been launched, and of course, the Optimist bot. And so it's all this that's keeping the market excited and a premium valuation of Tesla. I know a lot of people argue it doesn't make sense, it's not fair, it's a scam, it's been manipulated, etc. But that's what every company's supposed to do, attract a premium valuation so they've got the strongest capital base and biggest advantage to fulfill their ambitions. Tesla just does that better than any other company, but not too far behind, and maybe even better if you look at a price to sales ratio. Palantir done a fantastic job at attracting a premium valuation, with a market cap over 310 billion, even though it only did just under 3 billion in sales last year. Again, it gives them a huge advantage that has a halo effect as it builds further confidence in partners, employees, investors, suppliers, and customers when they see the stock doing well. But not doing well today is a stock I recently invested in and retail favorite, Oscar Health, as another health insurer, Centene, withdrew its 2025 guidance, and that sent fears and ripples throughout the sector today, with Oscar getting a bunch of downgrades from Wall Street, as they often chase price like a herd of sheep. But the fact is, this is a new retail favorite for good reason. The company's growing really fast, with insiders heavily invested in the stock, buying it late last year on the dip, and I've seen this quite a few times before, and other similar stocks, and I believe it's a case of a broken stock, not a broken business, which could actually prove to be a buy the dip opportunity. In fact, I can see it's already bumping up here after hours as I speak. As like I said, revenue is absolutely on fire, and they've just reached profitability. Market cap still only 3.6 billion, and just going out to the weekly chart here, still technically within the base. Obviously, if we were to take out $13.50 and even $11, that base could be lost, but you'll see this quite often again and again in hot stocks. They're good at shaking out the weak hands, only just to turn around a month later and rip to new all-time highs. So I'm still long this stock, as I use my own trend following model to keep me in, and it's still well above my current trailing stop on it. And so this is just part and parcel of investing. You've got to be able to tolerate short-term volatility and stick to your strategy, no matter the headline or fear that's been thrown around on this name today, as it is off quite a bit, which also reinforces the need for diversification. No matter how sure you are on a stock, you should never go all in on anything. And that's why my stock picks portfolio, which this stock is a part of, is still up more than double the market today. And that's because it's got 23 positions diversified across many industries. Moving on to another big item in finance today, United Kingdom borrowing costs spiking up amid doubts over the finance minister's future, with the risk being that the UK fiscal rules, proposed budget cuts, and remaining UK fiscal responsibility will go out the window, with the Prime Minister deflecting questions about it, and that is obviously upsetting the bond vigilantes. Dumping British bonds today, causing yields to spike, especially in long tenors. 30-year up over 21 basis points, 543. And this is on top of other woes for UK capital markets, as we've seen a number of companies cancel IPO plans, moving their primary listing out of the UK, and it'll be a huge blow if their biggest company, AstraZeneca, leaves as well. And I've heard this personally from some people I know. There is a bit of an exodus, with wealthy Brits packing up and leaving, not liking the direction of the country, in addition to capital markets just being more and more choked with tax and regulation, because for some reason, many leaders over there are hell-bent on washing away their national identity, their values and culture, for which the empire was built on. And you've heard of the term a lost decade in stock markets. Well, the United Kingdom has now had 3 lost decades. But is it too far gone? Will it ever come back? I'm not sure if it can, especially when you've got some of the best and brightest leaving the country. And again, it just plays into the argument that American exceptionalism isn't dying, because if it is, you have to look at alternative. The UK and Europe, I can't see fundamentally outperforming the States anytime soon. The next after that is China, which is still a very risky place to invest capital as well, given they're still communist run. You don't really technically own anything. The government owns the property, along with having technical right over your ownership and shares as well. They can pretty much yank anything from anyone with very little legal recourse. So again, what's the alternative to American stocks? Not much, if you ask me. And I think you'll find a lot of those wealthy people from the UK will relocate to the States, especially if they can get a Trump gold card and just buy their way in. And to make things worse, UK's most popular sausage roll seller plunged 15% as a heatwave hurt sales. Greggs shares were trading 15% lower. The Brits just can't seem to catch a break. And there's a look at Greggs stock price on the London Stock Exchange. What you'll notice is the liquidity is just a fraction of similar size American stocks, and that's because they have a whole lot more barriers to trading and entry, stamp duty, taxes, regulation. London used to be the home to finance for many, many years, and no doubt it's still big over there, but I for one think they have been and still are going in the wrong direction. As much as I would like to see them go in another direction, they're just not. And on that sour note, that brings us to an end of the daily market review today. Just looking at the VIX here, still coiling up on a 16 handle. And just looking at the VIX one day tomorrow, did pop up a little bit, but only to 16, which implies option dealers are forecasting a 1% movement in the S&P 500 tomorrow, up or down. So if the jobs report did come in really bad, that would be a bit of a surprise to the market here. And then it could actually uncoil, given that liquidity is going to be really thin tomorrow, half-day trading. Sometimes you can get funny games on those days with the algos. Otherwise, just like most trading desks, I'm also taking a long weekend, and so I won't be in tomorrow unless we do get a big day that I might show up and do a daily market review. Otherwise, markets are shut all day Friday as well, so I'll be taking a few days off, just like many Americans who will be celebrating their independence and split from British rule, now going on 250 years. This weekend for Independence Day. Otherwise, thanks for tuning in. As a reminder, all my content is just my opinion, and I don't expect everyone to agree with me on everything, and that's why you're welcome to share your opinion in the comments below this video. And if you haven't already, subscribe to this channel, and I'll keep bringing you my perspectives on the markets and everything else affecting them every day after market close. Enjoy your weekend, guys. I'll see you back here come Monday night. Cheers.